In this example, we will be looking at the calculations in the journal entries for mortgage payable. Cavro Corporation purchased a building by signing a $150,000 long-term mortgage with monthly payments of $200, and the mortgage carries an interest rate of 12%. So the company went in and got a loan for $150,000 in order to buy a building. So we call that a mortgage since we're buying real property. So we're going to prepare a monthly payment schedule showing the monthly payments, the calculations of the monthly payments and interest, and then we're also going to prepare the journal entries that accompany each of those. So in looking at the mortgage interest payments, first we have to take a look at what our unpaid balance is. That's the principal amount. So since we are in month 0 and have not made any payments, our principal amount is $150,000, the amount that we borrowed. Now we're going to look at month 1, and in month 1 we're going to calculate our interest first. Interest equals principal times rate times the time. So our principal balance is $150,000 times our annual rate of 12%, and then times our time period, which is 1 month out of 12. So when we calculate that, that gives us an interest of $1,500. And then we calculate our monthly payment minus interest. So our payment is $2,000 a month minus the $1,500 that goes to interest, gives us a $500 reduction in debt. So our payment is $2,000, but our principal balance only goes down by $500 because the $1,500 goes to the interest, the fee to the bank. So you can see that our new unpaid balance is $149,500. So now we're going to do the same thing for month 2, only now what happens, we're still calculating principal times rate times time, but our principal is now $149,500 times 12% times 1 over 12 gives us interest of $1,495, and then our monthly payment would be $505. So you can see that the interest is slowly going down, and then the reduction in our debt is slowly going up. So our new principal balance is $148,995. So for month 3, we're going to take the $148,995 times 12% times 1 over 12. So we now have an interest of $1,490. 2,000 minus the $1,490 gives us a reduction in debt of $510. So that's the table, that's the calculation in determining how much of our $2,000 payment is going to interest and how much is actually going to a reduction of our principal amount, which is our debt, the amount we originally borrowed. So after 3 months of paying $6,000, we still owe $148,485. Let's look at the journal entries that accompany each of these. So we're going to prepare the journal entries to record the purchase and the first 2 monthly payments. So here's our table that we created, and we'll go off of month 0 to record our journal entry for the purchase. So we purchased the building, so we debit building, that's our asset, and then we credit the mortgage payable, which is now our liability account of $150,000. Then for month 2, we're going to record interest expense and then actually payment. So we're crediting cash for the $2,000, the actual amount that we're paying to the bank, but then we're going to debit our mortgage payable account for the amount of the reduction in debt, the $500, and then debit our mortgage interest expense for the $1,500 that we calculated for month 1. And we'll do the same thing for month 2, only using the numbers we calculated from the table. So we're still paying $2,000 in cash. Our debt reduction, debit, decrease on our mortgage payable is $505, and then our debit to mortgage interest expense is the $1,495 that you can see from the table above.